Money. Money.
I love it when my guests are over here just dancing with a little money chat music. And today I'm going to bring into studio for you credit tips to increase your credit score. Your credit matters, and today I want to share some of those tips that make a difference in your credit score. Your credit score or FICO score determines the term and your interest rates that you pay on credit cards, car loan, mortgage loan, and even the cost of your car insurance. A lot of employers are looking at your FICO score as well to make a decision on whether or not they're going to hire you for that employment. So it's important to have some tips on what you can do to increase your credit score and to keep your credit score favorable for all of these areas of your life that it's going to affect it. Credit scores vary from the low 300s to the 850s. Your FICO score is the middle score from the three bureaus used: Equifax, TransUnion, and Experian. 760 or higher is considered excellent credit score, and then when you get to the 660 or low, that's considered the challenging market and or credit bracket where you need some tips and some work on that. So we'll go over that today. Why are consumer credit reports different than when the lender pulls your credit? That's a really common question that you'll hear. I hear it a lot in the mortgage industry. Clients come in and they've pulled a free credit report maybe through my FICO score, and the score is different than what it is actually for a mortgage. Now, here's the surprising thing. It actually would be different when you're pulling your credit for a car loan as well, or for credit cards, because there are 52 different algorithms that are used to pull your credit, different statistics that affect the risk of default in these different areas. The risk of default when you have a mortgage is going to be different algorithms used than a risk for default when you buy a car or credit cards. So when you're pulling your credit report, there's nothing wrong with taking a look at where your FICO score is to give you an idea, but that's just what it is. I've seen scores vary, sometimes 30 points from one algorithm used from another. Now, components that are going to affect your credit score, obviously delinquents. So you want to do everything that you can to make sure that you pay your bills on time. If you do pay them late or get that bill late into the mail, or online payment is a little bit late, as long as it doesn't go over 30 days, it's not going to reflect as a delinquent on your credit report. 35% of the credit score represents from delinquency. So that's why it's a really important part of that chart, that pie chart that's going to affect the credit score. Debt to credit utilization ratio, you want to keep that represents 30% of the credit score. So you want to keep that, if at all possible, at 30%. So whatever the available credit limit is to you, you want to make sure what you owe is 30% or less of that available amount to you. If you go over 50%, then that can be pretty devastating for your credit score. So this is a simple fix. If you're on your credit report, you owe more than that. If you can pay that down, you can do what's called a rapid rescore, which will have a pretty quick effect to that actual credit score based on paying those liabilities down. A lot of times you see this if you're somebody that uses your credit card on a monthly basis. I do, so I just pay it off every month, but it can get up over that 50% sometimes, depending on what my monthly expenses are. So you just want to make sure you're not doing that at any time that you're taking out a loan. Or again, if you're in a position to pay that down, then a rapid rescore can be done. Average age of your credit is 15%, represents 15%. So what you don't want to do, and this is something that you cannot recover from, and it's a myth that you'll hear if you're not using your credit cards, close them out. That would not be an accurate statement. You definitely do not want to close credit cards out that you're not using, especially if they have a history associated to that. So 2 years is kind of that when you're really starting to see some positive effect from that. Age of that credit is 2 years. So if you have credit cards that have been open for over 2 years, 5 years, 10 years, and you close it out, you can't recover that, because even when you get a new credit, now you have to reestablish that. So the age and the amount of credit that you have and the history is 15% of your score. Now, what you can do if you don't have established trade lines, so you're just starting out your credit, maybe you're a younger listener, go to mom or dad or a great friend or something and ask them to add you as an authorized user to some of their long-established accounts. You don't have to have access to it. They don't have to give you a credit card, but just add you onto the account as an authorized user, and that's going to help to build that average age of credit, which has such a big impact on your actual score. And the mix of credit is important too. That represents 10%. Every one installment, you want to have 3 revolving trade lines. Now, you do want to be careful with this. You want to consult with a mortgage expert, or depending on what type of loan that you're getting, to not to just go out and open credit cards because it may have a negative effect. So they're because of the other parts of the score that affect it. But just from that piece alone, the mix is 1 installment to 3 revolving. So an installment debt would be like a car payment or a student loan. Your revolving debts are all your credit cards or revolving liabilities. And then, of course, there's the inquiries. The inquiries represent 10% of your score. 7 inquiries a year before it affects your score in a real negative way. When you hear that you really don't want to have your credit report pulled from multiple mortgage consultants, I will say, being in the profession, as long as it's within 30 to 40 days, depending on which one of the bureau, it is not going to affect your credit score by having it pulled by multiple lenders. But when you get past that point, it definitely can. So you just want to be cautious on that. Tax liens, pay your tax liens. Once they've been paid, they can actually be removed. So that can have a huge impact on your credit score. Released and satisfied federal credit liens can be deleted from a credit report and all public records within 30 days. Some unpaid tax liens can be deleted. So federal tax liens can also be deleted if they've had balances of less than $25,000 with an on-time payments to the IRS. Can have a huge impact on your score. We talked about adding authorized users. Add secure credit cards. So again, if you're short trade lines, the authorized user is the best option because of the established account. But if you don't have a family member that's willing to allow you to do that, you can add secured accounts. And you can go to OpenSkyCC.com, and it's a great resource to get those secured cards if for some reason you're having a hard time getting approved for a card because you don't have any credit history. Keep balances below 30%. Again, that's a big one that we discussed before. Consolidating student loans. When you have multiple student loans, consolidation is good for many reasons, but for your credit score, it can have a huge impact by consolidating the student loans. Also for debt to income ratio purposes, depending on the type of loan, if you can amortize those payments over a longer period of time, sometimes that can help as well on qualifying. And put the burden of proof back on the creditor. So I want to end with this one before I take us to commercial. If you get a speeding ticket and you have an attorney take it to court for you, statistics will show that 70% chance that the speeding ticket can be removed from your record. Not saying that you weren't speeding. Let's say that you were. Credit works like that as well. there are ways that credit bureau or your creditors are reporting to the credit bureau that are out of Fair Credit Act for you. So if they can't produce the documentation that's required, then they have to remove those accounts. So it might be in your best interest, if you've got some challenges with your credit, to talk with a credit consumer, a credit repair company, and find out what violations are on your credit report. A lot of times it's really easy to get collections wiped out. So take a look at that, go through that process. They can be pretty inexpensive if you're with the right company. And if you need a resource for that, as always, that's what I'm here for, to be a resource for you on anything that has to do with your financial, family finance, and your future when it comes to money. And I've got all of the experts that can help you. So call the show at 1-855-400-1150 or go online to themoneyhour.com. And coming up next, will my child be able to afford a home in King County? Well, we have Russ Elkinson here, CEO with Seattle King County Realtors, right here at 1150 AM KKNW after this short break.